Assalamualaikum madam, my name is Nofata Nabila bin Jamal Fitri. Today, me and my group members will present about financial analysis for group project 2 in the subject ACC466. Moving on to introduction, the two companies that we choose is 99 Speedmart and Mr. DIY. For 99 Speedmart, as we all may know, 99 Speedmart dominates Malaysia's proximity grocery market under its near and safe model. It operates nearly 3,000 mini markets placed directly inside the residential neighborhoods, focusing on high-frequency, daily FMCG staples and lean retail operators. Next, moving on to our second company, which is Mr. DIY, Malaysia's largest home improvement retailer with over 1,400 stores. It leverages massive economies of scale and a direct sourcing model to deliver its core, which is always low prices, value proposition across more than 17,000 product SKUs such as hardware, household, and lifestyle goods. First, as we all may know, we have 4 types of financial ratios such as liquidity, profitability, leverage, and efficiency. Now, I am going to show the liquidity part of the company 99 Speedmart and Mr. DIY. A company's liquidity ratio indicates that the company's ability to pay the current liabilities. So, higher ratios are better because the company can easily meet its short-term debts. Current ratio formula are current assets over with the current liability. So, the current ratio that we got for 99 Speedmart and Mr. DIY are 2.24 and 1.55, which means for every 1 ringgit of current liability, Mr. DIY Group Berhad has 2 RM 2 ringgit 24 sen of current assets to repay the current liability, which is better compared to 99 Speedmart Retail Holdings Berhad, who has 1 ringgit 55 sen of current assets to repay the current liability. Next, we're moving on with the quick ratio. So the quick ratio formulas are current asset minus inventories minus prepayments and over with the current liability. So the quick ratio that we calculated for 99 Speedmart and Mr. DIY are 0.49 and 0.71, which means for every 1 ringgit of current liability, 99 Speedmart Retail Holding Berhad has 71 cent of its liquid asset to repay the current liability, which is better compared to Mr. DIY Group Berhad, who has 0.49 cent of current assets to repay the current liability.
Now, let's look at our profitability ratio. This is our calculation for net profit margin. From here, we can see that for every 1 ringgit sales, Mr. DIY Group Berhad generates 13 cents of net profit, while for every 1 ringgit sales, 99 Speedmart Retail Holding Berhad generates 5 cents of net profit. From here, we can see that Mr. DIY is more profitable than 99 Speedmart. Next, let's look at our gross profit margin. This is the final calculation for our findings. From here, we can see that for every 1 ringgit sales, Mr. DIY Group Berhad generates 48 cents of gross profit, while for every 1 ringgit sales, 99 Speedmart Retail Holding Berhad generates 20 cents of gross profit. From here, we can see that Mr. DIY Group is more profitable than 99 Speedmart.
Moving on to our profitability and efficiency metrics, let's look at return on asset or ROA. This metric shows how effectively both companies use their total assets to generate net profit. Mr. DIY leads slightly here with an ROA of 16.14% compared to 99 Speedmart at 14.64%. To put that into perspective, Mr. DIY generates 16 cents of profit for every ringgit of asset they own, while 99 Speedmart generates 14 cents. Both companies are highly efficient, but Mr. DIY has a slight edge in sweating in assets. However, the picture shifts when we look at return on capital employed or ROCE, which measures how well a company allocates its debt and equity to generate operating profit. Here, 99 Speedmart takes the lead of an impressive ROCE of 33.74%, outperforming Mr. DIY with 28.37%. This means for every single ringgit of capital deployed, 99 Speedmart generates 33 cents of operating profit, while Mr. DIY generates 28%. In short, while Mr. DIY is slightly better at driving profit from its overall asset base, 99 Speedmart is actually more efficient at generating return from the actual capital invested into the business.
Next, looking forward to our efficiency ratio, 99 Speedmart records higher inventory turnover at 7.29 times compared to Mr. DIY 2.30 times. This proves that 99 Speedmart clears and restock much faster. This directly reflects to their business model, which is 99 Speedmart groceries that required rapid sales cycles, where Mr. DIY manage household goods with a natural longer shelf life. Next, looking at average collection period, we see that 99 Speedmart takes 6.96 days and Mr. DIY takes 6.80 days. So for this calculation, we assume that all revenue comes from credit sales because the actual credit sales data is not declared in annual reports. Despite that, we see that both companies collect their cash in less than a week, showing that they have an excellent cash flow.
Now, let's look at the efficiency for the total asset turnover ratio, which measures how effectively a company uses its asset to generate revenue. Here we see a massive contrast in operational strategy, where Mr. DIY recorded an asset turnover of 1.28 times, while 99 Speedmart achieved an impressive 2.95 times using an almost identical asset base. This means for every single ringgit invested in assets, 99 Speedmart generates nearly 3 ringgit in revenue compared to Mr. DIY 1 ringgit and 28 cents. This gap perfectly reflects their business models, where 99 Speedmart relies on a high volume, fast-moving consumer goods model with rapid inventory turnover, giving them a significantly stronger performance in pure asset efficiency. Moving on to our leverage analysis by examining the debt ratio, this ratio analysis is crucial because it reveals how much of each company's asset base is funded by debt or equity. Looking at the data, Mr. DIY stands in a very good financial position with a debt ratio of 48.57%. This shows that half of their assets are safely backed by equity, giving them a strong buffer against market volatility. In contrast, 99 Speedmart operates at 59.47%, while this higher reliance on leverage is highly effective for maximizing their operational scale. It introduces a higher risk profile. Ultimately, Mr. DIY offers a much better capital structure for long-term stability, while 99 Speedmart opts for an aggressive debt-driven growth strategy.
Next, let's look at the debt to equity ratio calculated by dividing total liabilities by shareholders' equity. So this metric shows how much a company relies on debt versus its own funds. Mr. DIY takes a conservative approach at 94.45%, meaning their equity comfortably outweighs their total liabilities, signaling lower financial risk. So in contrast, 99 Speedmart is more heavily leveraged at 146.74%, indicating that they rely more on liabilities to fund their retail operations. In short, Mr. DIY favors a safer, equity-first structure, while 99 Speedmart pursues a more aggressive, leverage-based strategy. Next, the time interest earned ratio measures a company's ability to service its debt. By dividing earnings before interest and tax by interest expenses, it tells us how many times over operating profits can cover annual interest bills. Mr. DIY achieves a very healthy 12.04 times coverage, meaning they can pay their interest 12 times over. However, 99 Speedmart excels even further at 17.77 times, thanks to highly optimized financing costs relative to their earnings. Ultimately, while both companies are incredibly safe and well clear of danger, 99 Speedmart displays a superior capacity to manage its immediate borrowing costs.
To wrap things up, our ultimate choice as potential investor is Mr. DIY, while 99 Speedmart is incredibly fast, effective machine with a rapid inventory turnover. It comes with much higher debt risk. So on the other hand, Mr. DIY stands out as a highly profitable choice, generating a superior net profit margin while protecting a shareholder with a much safer, lower debt capital structure. Therefore, for investors looking for maximized return with a minimal financial risk, Mr. DIY is the winning option. That's all from our presentation today. Thank you.